Good morning. It's Thursday, the 18th of July, and this is Govindraj Ethiraj broadcasting and streaming from and headquartered in Mumbai. The Take. Now, if you've been a regular reader of the Core, the newsletter, or a listener of the Core report, you would have known that this was a when question and not a if question. The National Company Law Tribunal has started insolvency proceedings against edtech firm Baiju after India's Cricket Board, the Board of Control for Cricket in India, complained that it failed to recover around $19 million of dues. Now, Reuters reports that the tribunal has appointed an interim resolution professional who will now oversee the management of this edtech company. The powers of board of directors will be suspended for now and rest with that interim resolution professional. The court has also argued that given all the federal tax and economic offences cases, including by the Enforcement Directorate, filed against Baiju, the company's value was effectively zero and not some in the billion or billions of dollars range as many were fantasizing about. Now, the irony is, of course, there for all to see, that the organization that dragged Baiju or has dragged Baiju to bankruptcy court was the one which made its players proudly sport the Baiju brand on their t-shirts, which you must have seen if you were watching some of those cricket matches a few years ago. The branding, of course, helped hawk expensive supplemental education courses to unfortunate young students, pressurized in turn by insecure parents. And there is no better business model in India than perhaps preying on insecure parents with nonsensical online courses, and I do wish we did more to address this problem. Which of course reminds me that this will not be the only brand on Indian cricketers' t-shirts to meet this end, and if a few more have not yet reached the graveyard as they should, it's because venture capitalists are still pumping away capital as they wont to till the very end. And we will touch upon this a little later as well. So visualize someone huffing and puffing on a bicycle pump without a tire or a bicycle connected to it. Now, Baiju's demise, of course, was a long foregone conclusion, but a free market must allow all firms to try and perish if they fail. But there should be exceptions, like businesses which target parents and lock them into EMIs or equated monthly installments that they cannot pay for courses that they should not be doing, at least their children. Now, even if you take away the fact that companies like Baiju and many more have messed around with children's lives, the flood of capital creates severe distortions up and down the economy, particularly in areas like this. And in this case, creating a perception of jobs which rarely or barely exist beyond a few years. The perception of jobs creates a cycle of artificial demand and thus inflated supply, which works back into the education system in this case. For example, for several years, the hottest jobs at campus placements were edtech companies, and I'm sure many, perhaps thousands of teachers have quit other jobs or thought that they could spend the rest of their careers teaching online courses to students in edtech companies like this. So this is a problem that, of course, extends across the economy. A robust free market, just to come back, is essential to correct imbalances and overreach, but allowing casino-grade capital to enter areas like education, or for that matter, quite literally casinos, is something that policy must step up and control. India has fortunately taken steps in that direction. We must not slow down now. And our top stories and themes for the day: global cues are weak going into Thursday trade. Oil prices are down, but stronger US demand is countering weaker uptake in China. Gold hits a fresh record high. Mega deals are driving private equity investments into India's real estate, led by warehousing, and monkeys in the circus and venture funding in electric vehicles.
This is the Core Report with Govindraj Ethiraj.
Global cues are turning weaker. Indian markets are being driven by an excess of supply of funds, mostly through the mutual fund route, and little fundamentals, or rather little off fundamentals, at least for many stocks, and at the stratospheric valuations they're quoting at. On Wall Street and elsewhere, investors appear to be questioning once again whether the tech darlings led by Nvidia are worth the sky-high valuations they're sitting at. Stock futures slid on Wednesday as the rotation out of high-flying technology shares continued. The Dow Jones shed 129 points. The S&P 500 and Nasdaq 100 futures were also down overnight, CNBC reported. Apple and Tesla, yes, Tesla is a tech stock, dropped around 2% before the bell. Semiconductor stocks fell after Bloomberg News reported that the Biden administration was considering tougher trade restrictions if companies continued to grant China access to US-made technology. And the US-listed shares of Taiwan Semiconductor, or TSMC, lost around 4% in pre-market. Back home, the BSE Sensex touched a record high of 80,898 intraday on Tuesday, before ending at 80,717, up 52 points, while the NSE Nifty50 hit a new high, not surprisingly, of 24,661 before closing at 24,613, up 26 points. Now, this was on Tuesday. Wednesday was a holiday in the markets because of Muharram. And in the broader markets, the BSE mid cap and the BSE small cap was down and up, but very slightly. It's the US versus China when it comes to crude prices. Oil steadied after a 3-day drop as there appeared to be a fresh fall in US crude stockpiles, making up for weakening demand outlook in China, according to Bloomberg. Brent traded below $84 a barrel, and US crude stockpiles shrank by about 4.5 million barrels last week, according to the American Petroleum Institute. China reported its slowest growth in 5 quarters in the 3 months to June, and the International Energy Agency has projected weaker oil demand growth there. To get a sense on which way oil prices are headed and whether or not countries like India can continue to benefit from cheaper Russian crude, I reached out to Paul Hickin, editor-in-chief of London-based publication The Petroleum Economist, and I began by asking him about overall crude price trends right now and ahead.
We've seen it from really the start of the year that oil market's been very range-bound in the $80 to $90 barrel mark for Brent. And yes, you're right. Ultimately, the weakness on the demand side has come from China. It's been underwhelming. We've seen GDP around 5% growth, which is quite low for China. It's got huge residential underlying problems with its residential property market, which is really hampering its growth potential. We've seen it with sort of the PMI indexes of just below 50, which is a mark of a slight contraction. And the market's really been a bit wrong-footed. They expected China demand to come back much more strongly than it has, and that's been a real cap on the bullish moves in the oil market. And then you've got on the flip side, which is the US, which you mentioned. In a sense, the US, while demand is staying strong, it's actually inflation which has been away on market sentiment from the US side, because it means interest rates have stayed high. And the expectations interest rates, as we've seen in the start of the year, most people expected US interest rates to start coming down, and they haven't. And everyone still keeps talking about US interest rates coming down. And again, still everyone's waiting. And that is keeping also a cap on prices rising, really. And ultimately, what has helped the bullish trend, or keep prices in the sort of 80 to 90 range, has been all these OPEC cuts, which OPEC has had to go, OPEC plus, should I say. And these OPEC plus cuts have gone way beyond the probably OPEC plus expected and the market expected. We've had these extra voluntary cuts from a core group of 8 key OPEC producers who have come together to try and take extra barrels out of the market, and they've really gone hard at it. And what we're starting to see in the market over the last month or so is that a key barometer is US stocks, and they've started to come down, and that's to suggest markets showing more rebalancing and that there's more tightening in the market. But while there has been tightening in the market, that has been capped by those, especially by the Chinese weakness and sort of a general underwhelming sense that demand isn't quite as strong as may have been previously. So that's keeping market really range bound and may well do in the foreseeable future as well.
Right. How are you seeing the overall risk premium levels right now? And I'm obviously talking about geopolitical risk and the Middle East tensions, which we were talking a lot about a couple of months ago, but maybe not that much now.
Yeah, it's true. I think there's not much risk premium in the market. I think even when there was, it's something people talk about when the fundamentals are less interesting or a little bit, there's less news to play off of in the market. But realistically, the geopolitical risk premium has been low because while the Middle East, we talk about it as some generic, or we're talking sort of more broadly about the Middle East, the key areas where there's been tension there's not real significant risk of supply disruptions, and which is when we talk about the Gaza region, the atrocities there. So it's more of a fact if it spills over to areas like Iran, to which is partially involved, and then or the Strait of Hormuz, a key maritime and choke point where a lot of oil and gas flows flow through, and if that was to be disrupted. But at the moment, the market calculates that that's very low, that risk, and that when there has been heightened tensions between, for example, Israel and Iran, they've managed to, realistically, there's no one would want to escalate to that point. It's a lose-lose situation, and it's been de-escalated quite quickly as a result. So I think geopolitical risk is quite low, and really it's and even when that has been there, it's more intraday volatility. Ultimately, it's fundamentals which drive the market. And even when we talk about geopolitical risk, it's worth bearing in mind that it's the calculation of risk is actually supply disruption. And ultimately, OPEC is the one bringing the supply off the market.
Right. And how are flows from Russia looking like right now? So India has obviously benefited in the last 2 years since the war, or rather the invasion of Ukraine by Russia, because of lower prices and rather discounts. Now, those discounts seem to be going away, but what's your sense on how prices could be in the Russia, from the Russia and particularly Russia to countries like India?
Yeah, so let's put that into context first of all. And the sanctions that were placed and the caps that were put in place by the West were always designed to not to stop Russian flows, but to hurt Russian revenues, and that as a result, India and China have been key beneficiaries of those moves. And there was always the ways to be designed like that, so that countries like India and Russia could still buy that crude, but get it at a discount. And that's exactly what's happened. China was always a fairly strong buyer of Russian oil, but India has gone, like we've seen, from zero to hero. It's record numbers. And the Indian Energy Ministry has made no mistakes in its clarity about its strategy, which is it wants to buy oil as cheap as possible for its consumers. And that's what it's done. And Russian oil has been at a discount, and that's exactly what it's done. But you've got to remember, I think it's important to remember that while they have gone and purchased a lot of Russian crude, the Middle East crude is still an important part of India's energy mix. And there's always been that interplay between Russia and some of the Middle Eastern grades, Iraq, Saudi grades, which India's always relied on way before Russia and will continue to do so. And while India does see price as the main driving factor, there is also a important factor, which is diversity of supply, to make sure you've got your options open. And the Middle East has been a key supplier of grades to India. And that's, if you look at the Middle East as an entirety of its supply to India, it's actually more than Russia even now. But it's only by an individual country basis, which it's less. So you could look at it two ways. So yes, India will still continue to buy if there's a discount, and which is likely to be there. But at the same time, India will also be quite aware that it would still keep to buy a lot of the Saudi and Iraqi grades, which has been a staple of Indian refiners' diet for a long time, way before the Russia-Ukraine crisis.
Right. Paul, thank you so much for joining me.
Thank you.
Gold jumps to a fresh record. Gold hit a record high as hopes for Federal Reserve rate cuts rose once again. And of course, the markets are also stepping up their bets on Donald Trump returning as president. Spot bullion rose as high as $2,469 an ounce, moving past the previous all-time peak set in May. So in 2 months, essentially, gold has bounced back. Lower interest rates make gold less attractive as gold depends on capital appreciation. Gold has, of course, risen about 20% this year all over the world, including in India, supported by large purchases from central banks, again, including India and China, and strong consumer appetite in China. The big trend this year, of course, has been geopolitical shifts causing demand for gold to rise. China has slowed down its purchases after months of incessant buying, possibly because of high prices, at least according to some reports. A commodities strategist at ING Bank told Bloomberg that gold was poised to keep its positive momentum going amidst the current global geopolitical and macroeconomic landscape, and also predicted that central bank demand would continue to grow. Bloomberg also says that gold's latest rally is not necessarily unexpected, adding that in June, consultancy Metals Focus had predicted a fresh record this year. And Citigroup, which we also reported here, had said that its base case for gold in 2025 was $2,700 to $3,000 an ounce. If you like what you are listening to and would like to collaborate with us at The Core Report, here's some good news. We are happy to announce the launch of the Core Brand Studio. Write into my colleague Shiva Chaudhary at shiva@thecore.in. I repeat, Shiva, that's SHIVA, at thecore, THECORE.in for more information. Mega private equity deals in real estate. Some $3 billion of private equity have flowed into real estate in the first half of this year in India, of which half has gone into one mega warehousing deal. That single deal of $1.5 billion was between Reliance Retail Abu Dhabi Investment Authority and KKR, or Kohlberg Kravis and Roberts. The residential space grew at about 29% and office grew at 20%. This is private equity coming into these spaces. Foreign investors represent close to 80% of private equity investment in real estate, and both office and residential have seen good growth. Now, most private equity investments are flowing into Mumbai and its surroundings, including obviously into that big warehousing deal, which reflects underlying strength in logistics. I reached out to Vivek Rathi, Director of Research at Knight Frank and also author of this report, and I began by asking him what was driving these big deals.
So, if you look at the Indian real estate space, the indicators on the private markets, private investment markets, were promising even for the last, say, 4 or 5 years, barring the last 2 years when interest rates peaked in the Western economies, which are essentially the capital suppliers for real estate sector. So, private investors were glued into real estate sector. It was the public markets which was really finding difficult times with investor appetite towards real estate companies and the sector in general. However, over the past 3 years, what has happened is on performance front in terms of demand, supply, pricing, the real estate sector has done really well, which has ensured that the public market interest has come back, and that's showing up on the public market charts. But on the private equity side, the numbers indicate that domestic investors have been active, and for the foreign investors, particularly one from the US, Canada, and such regions, despite the interest rate levels continuing to be at their highs, investors have committed to the cause of in real estate in India. And that is showing up in the latest period. So we are in H1, we have investment volumes in the real estate sector, which are close to the full year recorded in 2023. And if the trend continues, which is very likely on account of various reasons, 2024 will be the best year in the last 3-4 years.
So there clearly have been one or two deals which have swung the needle, so to speak, because there's one warehousing deal which is worth almost $1.5 billion of the total $3 billion that came in. But if you were to take that deal out, how is the overall outlook for warehousing specifically and versus, let's say, residential and office in terms of private equity flows?
Yeah, even if you see the past periods, the last 3-4 years, the warehousing sector has accommodated close to $1 billion in each of these periods. And therefore, some or the other large deal in different time periods has been a phenomena even in the past. Having said so, in terms of the operating performance of the warehousing sector, from the occupancy-led transactions perspective, which is the reflection of demand in the warehousing sector, the sector has shaped up well in terms of the scale and the interest level of occupiers on the warehousing side. Now, what has been a concern to some extent is the rent growth in the warehousing sector. Okay, and there the expectations have been riding high for the last couple of years. Just that rental growth has been limited compared to the expectation investors were carrying. Okay, going forward, new demand comes in, and also investors become more active in the warehousing sector. We think that the warehousing sector will continue. However, the number one position will again, be taken over by office sector because it has a wide pool of assets and participation of international investment strategies, and the battle will again be with office soon.
Right. Just within warehousing, I'm assuming most of it is driven by e-commerce and logistics and the growth there. But is there Anything more or significant in the underlying growth in warehousing, or is it, as you said, more linear, and it's only these one-off big deals that might be happening?
In terms of investment deals, it's generally platform driven deals or deals which aggregate multiple assets, and therefore, one or the other big ticket deals happens spaced, between, say, half yearly periods or a year. But when it comes to the operational performance indicators, it is in the recent past, it's been the third party logistics sector, which has been very active, taking up space in the top 8, 10 cities and also beyond these. And that will ensure faster maturity when it comes to assets in the warehousing space, which will also show up on rentals as well as investments.
The composition of investment is interesting because foreign investors are almost 76% of the private equity investments into India. And within that, regions like Middle East are dominating as per your report. So do you see that shifting? I mean, more Indian investors going in, or is that something as an asset class which is still not so attractive for Indian investors or Indian institutional investors?
Yeah, so one big theme for a long time has been capital coming in from the Western economies, particularly US, Canada, Europe. But in the last 3 years, as interest rates increased steeply there, we've seen some shift coming from those regions to the APAC region, and investors in the APAC region have become a lot more active in the recent past. When it comes to Indian investors, we've seen heightened activity when it comes to domestic fundraisers, and that has ensured his activity. But having said so, the dependence or reliance in terms of big ticket deals and to pull the investment volumes going forward will still be from the overseas capital. Ultimately, we are a capital deficient country. We have multiple opportunities, but capital will have to flow in from countries which are able to provide it on a sustained basis on a high scale.
Vivek, thank you so much for joining me.
Sure, thanks.
Monkeys and venture funds. Uncertainty on the policy front makes predicting profitability for electric vehicles tough, Bajaj Auto Managing Director Rajiv Bajaj said at his company's annual general meeting on Tuesday, and reported by Business Standard. He was responding to a question from a shareholder. Bajaj makes Chetak electric scooter and is India's third largest electric two-wheeler firm by volume. It also makes electric three-wheeler segment, which of course is a hot one. The original Chetak scooter was launched in 1972, by the way, and was named after a legendary horse of a great Indian warrior and King Maharana Pratap, who ruled in northern India around 500 years ago. Back to the present, the newer and electric version of Chetak was launched in 2020. So the outspoken head of Bajaj Auto said that there was a lot of uncertainty as far as government policy was concerned, not in a bad sense, but in the sense that the same scheme as subsidies for electric vehicles kept changing from time to time. He also added that his company was not unduly worried about the subsidy issue since they made a 20% EBITDA margin with a cash reserve of 16 to 20,000 crore rupees, which put it in a better position compared to its rivals. Now, the cash reserve obviously came from profits earned over the years. Bajaj said that there was a side to him that wished that this segment would not be profitable for a long time because they could be the last scooter standing at the end of the day. Let it continue like this, he said. Let the circus continue. One by one, all the monkeys would leave the circus, and in the end, hopefully, Bajaj Auto would still be standing, he said. Presumably, when he referred to monkeys, he was speaking of companies that had aggressive, to put it mildly, venture funding, backing it, and thus unit economics at this time were not really a consideration. Bajaj also said that EV profitability was difficult to predict also because of other factors, and some of them were price, which was not really in their hands, and that was determined by the market. He said that they have a competitor that believed in dropping prices by 10,000 rupees every month. Now, obviously, he was joking, but I guess he makes the point. While India has seen high growth in electric two-wheelers, the overall electric vehicle market is now slowly flattening all over the world as demand is slowing down and manufacturers are cutting back both production and plans from the more ambitious goals set just a couple of years ago. In four-wheelers, hybrids now outsell electrics despite having to pay higher taxes. Bajaj said that their emphasis would be more on growth, perhaps more than it has been before, and that they were not wedded to 20% earnings before interest, tax, and depreciation. That's EBITDA. And it would be more an outcome of what they did, their sales, their price, the money they invest, and so on. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.